Well, everybody, welcome to Wall Street Hackers, one of the most exciting programs on the Pod TV network, and one of the most interesting programs where we discuss the stock market and investments, which is important to everybody and anybody who's listening. And with that, we're not only going to discuss the markets, we also look at the quotes of the week that we see from people that are very famous dealing with the market. We have stories of the week that deal with the market, Peter's pick, what stocks you may want to look at, and then finally a panel discussion. So with that, we're going to bring in the hacker himself, who received a degree in economics from UCLA, a master's in business administration with a specialty in finance from NYU, and a law degree from the University of Miami. Schlepping 17 years in New York City, working on Wall Street and investing, and longer than that in his personal portfolio, we're going to bring in none other than the hacker himself, Peter Bennett. Peter, welcome to your show.
Hey, Nick. Hi, audience. I wouldn't call it schlepping. Sometimes the commute was long. New York City has the worst commutes in the country, I believe. So, but even the railroad wasn't bad. I used to come in from Long Island or Westchester. So not bad. Anyway, welcome to Wall Street Hackers. You can catch a new Wall Street Hackers most weeks. It is July 18th, 2024. And you catch a new episode starting on Thursdays at 1 or Saturdays, depending on your distribution channel. So the markets, obviously the fight against inflation is going slower than the markets generally expected for a long time. But there was mixed data for sure. Retail sales, excluding autos and gasoline, jumped by 0.8% in May, month over month for May. That is a huge increase. It's a 9.6% annualized rate. The market focused on the CPI number, which I'll get in a minute, which was positive. The Atlanta Fed's GDP forecast for Q2 jumped to 2.5% from 2% recently. So these are not numbers where you say, oh, inflation is under control. On the other side, the market saw very favorable consumer price index numbers if you look at 1 month or even 2 months. It was 1.6% annualized in June from May. Now, it could be the change in a trend, but it might also be nothing at all. And why do I say that? Because these last two numbers were what are called outlier numbers from the general trends in terms of CPI. But here's the interesting thing. Since 2017, that's obviously 7 years, for 7 entire years, there have not been more than 2 outliers. In other words, every time there were 2 outliers, the next piece of data came in back to trend. So is this a break in the trend? Well, if you were going with the past, you'd say probably outliers and not the trend, but it's going to break eventually. Eventually, inflation will likely go down. They'll win the war against inflation, but I'm not convinced that inflation is under control at all. And the bottom line is likely 1 rate decrease this year, maybe. Most likely in December. The market's pricing in a very large percentage that it'll be in September, but I don't even think the Fed would do that because I think they'd be reluctant right before the election, but maybe. It all depends on the numbers. They're data dependent. We're all data dependent. So in any case, we will see. But Wall Street Hackers would mention another concern, which is more long-term, but maybe not so long-term. And that is, at some point, and nobody knows the answer to this, the Medicare and Social Security program flows are going to affect inflation and the economy. What do I mean by that? Inflows and outflows are going to shift because the government had been taking in huge amounts of funds for decades, and they've been spending the money. So they didn't have to print the money or tax the money because they had the money. But now the money is drying up as the balance of inflows and outflows changes. But my point about this is nobody knows nobody can possibly know when this is going to start creating pressure on the market in terms of inflation, and inflation is going to cause pressure on the market in the long run, obviously, because companies won't do well, the consumer won't do well with increased inflation. But nobody knows the answer to this. So it could already be happening, and it may not happen for years. But at some point, what I know is the massive amount of unfunded liabilities in the United States. That is for Medicare and Social Security, and it's on a GAAP basis. The generally accepted accounting principles that everybody, in terms of a household or a business, have to operate under should be applied to the government. So it's going to affect things down the road. We just don't know when it's going to really impact. And as I said, maybe it's already impacting it now and causing more difficulty in the fight against inflation. So we will see when that shift occurs, but whether it's slow or quickly, if it doesn't happen slowly, it will happen very quickly, and that'll be a catastrophe too. So what to do, as Wall Street Hackers has been saying for years, the U.S. and most of the world's other economies, I've looked at lots of economies to just see what's the situation in South America, in China, in India, in Australia, in Canada, in many countries in Europe, just to see, are their retirement plans funded? What are they doing about healthcare? Well, they're providing a lot of them free healthcare or very subsidized healthcare for aging populations, and they haven't put a lot of money or no money away. So they're in the exact same shape. So it's not like, oh, the U.S. is going to collapse and everybody else will be fine. Rather, it's going to be pressure, worldwide pressure, and that's almost certain. So what does that mean as an investor? Well, every country that's going to be facing this, certainly the U.S., is going to be wanting interest rates down to zero because they can't afford to pay interest on these gigantic amounts. I've already compared the amounts to more. The 125 trillion that they owe is more than the entire U.S. stock market, bond market, and privately held housing. They can't tax that much. They're going to be printing money. So they're going to want interest rates to be to zero, or else it will compound it. They're going to need inflation to be higher. So it's going to happen. So what you want to do is lock in income now, whether that's long-term bonds, whether it's pipelines, like we favor energy particularly, as you know, but long-term dividends, which outperform anyway. You know, we did a study. We talked about a study last week, which confirmed our favorite study that we've been talking about for years. The one study from the Hartford Fund shows that for 50 years, dividend stocks and growth stocks outperformed the S&P 500 up to 2022 for 50 years, doubling and tripling it. Now, then I found the Morningstar study, which was, I believe, 93 or 97 years to, I believe, 2020. I'd have to relearn that one, but I'm in the ballpark. 97 years roughly that high yield and dividend stocks outperform non-dividend payers and the market generally. So this is where you want to be: energy, high yield. Quote of the week, and this relates obviously. I admire Mario Gabelli as both a man and as an investor. I actually once met him, or actually twice met him, working out at a YMCA. From Mr. Gabelli, my biggest concerns remain the geopolitical situation and the U.S. debt and deficit. The Congressional Budget Office recently estimated the debt at $35 trillion and the deficit at $1.9 trillion. How will we raise revenue? How will we restrain expenditures under the next administration? What does the deficit mean for the tax outlook, consumer spending, and corporate profits? Great questions. Probably not great news, but it's a very good explanation overall of the situation and some of these compounding problems. But I disagree with him on one thing. He said and repeated what the press says all the time. You almost never hear any other number. They say 35 trillion, 35 trillion. We're approaching 35 trillion in debt. Problem is, it's not 35 trillion. How scared would people be if they told them the real debt? Some people know this. 125 trillion is an excellent estimate. David Walker, who was the general controller of the United States for under three different administrations, says that's the estimate. And whether he's off by a little or not, it's in the ballpark. It's certainly not 35 trillion. So These unfunded liabilities in the U.S. and the worldwide are going to severely affect the economy. We've got to adjust to it. We should be preparing for it. So far, people have been basically ducking the issues. 4 most interesting stories of the week. Interesting story number 1. I actually caught 14 errors in Biden's 1-hour speech that was supposed to redeem him. The media caught some of these errors, and pretty much everybody caught the one where he called Trump his vice president. But the one I'll focus on, which really I thought was ridiculous, was he said, and this may be an exact quote, it's very close, Trump just discovered what NATO is. And then he followed up by saying, but don't hold me to that. Really? The president of the United States saying something about a figure and then saying, which is totally ridiculous, and then saying, don't hold me to that. And it's ridiculous for a few fronts. Obviously, he knows who NATO is, but also this is something that Trump has been accused of. He hates NATO. He's that. Well, here's the reality. You don't want the president of the United States making anything up at all, not to mention the 14 errors. So yes, Trump was skeptical at one point of NATO because NATO, many countries in NATO were underfunding and not paying what they had already committed to. They promised to pay a certain amount. I believe it's 2% for a lot of them. They were underpaying. In 2018, the NATO Secretary General thanked President Trump for pushing the alliance to increase spending. So they had a bigger budget. He thanked them. Clearly, Trump knew who they were. Interesting story number 2. I'll just read this. BP released its annual energy outlook Wednesday. Its conclusion, oil demand will likely plateau by 2025, after which the decline will depend on how aggressively countries slash carbon emissions. But wait, there's more. OPEC also released its monthly outlook on Wednesday with a different conclusion. Oil demand is rising, and there is no sunset in sight. OPEC sees demand growing by 4.1 million barrels a day from 2023 to 25 and rising through at least 2045. But wait, still more. The Paris International Energy Agency forecasted a 2029 peak. The U.S. Energy Information Administration says the peak will be between 2030 and 2040. So basically your range is 2025 as a peak to at least 2045. And who knows if that's right. The point, it just shows how really market forecasts are varied and not always accurate. These all can't be accurate. So we suggest to investors our general philosophy, which is stay with energy, which is what we're doing unless we see a real evidence of a change, especially pipelines like MPLX. You can see the performance. We've been pushing it for years as a great investment. I still think it's solid, very solid. It's our largest equity allocation, a 3% allocation to KRP, which has done very well. They're an energy producer, and varied energy utilities and other investments. We mentioned a few Canadian oil companies and also utilities. We're going to get more into that in future weeks, but we're going to do a different series for a few weeks on food producers. So dividend, the other thing is, of course, we like our philosophy of dividend payers and growers. I just discussed it. The Morningstar study, the Hartford Fund study. You want to go where the odds favor you. And based on past performance, it's very clear you want dividend growers and dividend payers, and you'll outperform based on very strong evidence. The S&P 500, in the one study, the stock market in general, non-dividend payers, that's where you want to be. Interesting stories number 3 and 4, 2 health-related stories. I thought they were both interesting. Number 3, a doctor in Pennsylvania said, "It is a medical fact that thirst tends to diminish with age. Therefore, when our bodies are in need of fluids, we might not be aware of it. The absence of thirst does not ensure adequate hydration. Older adults must make a conscious effort to consume adequate fluids and water throughout the day. Making it part of a daily routine to drink at certain times helps." I told this to my martial arts instructor, by the way, and he said he has noticed that the little kids are taking drinks all the time and the adults hardly ever go for water. I know when I go to martial arts, maybe I get it 1 or 2 times. I'm thirsty now. I really was thirsty. It's hard to talk without a break now. I used to have a break in the middle. So you should be very aware as you're aging, middle-aged, older, to drink more water and to monitor that, because your body may not be giving you the right signals. Another interesting health story, number 4, according to ARP magazine, the average American consumes, and if Nick was on, I might have to play this game. You can't believe how many teaspoons a day of sugar, added sugar, not just sugar, because we all eat sugar naturally. The average American consumer eats 17 teaspoons of added sugar every day on average. 17 teaspoons of added sugar. So they said 90% of Americans experience food cravings. Well, you would know why that might be one reason. Their suggestion was eat a very protein-packed breakfast. I suggest, Wall Street Hackers suggest, whatever, several things. 1, eat more healthy protein in general. Start reducing sugars and especially white carbs, which are translated sugar. I do some part-time health insurance, and they used to ask medical underwriters and questions. And so I'd find out who had problems with sugar and stuff. And I would tell people, white carbs are converted to sugar in your body. It's just like eating sugar. And people say, really, really? And then at least 2 really heavy people, I mean, they couldn't even qualify maybe for health insurance, followed my instructions and they lost tons of weight. They said, I just cut out white carbs. So soda, white carbs, sugar, these are not beneficial. And finally, which relates perfectly to the only third point, is relating back to the O'Reilly study, drink more water, because it's a fact that many people drink water when they're thirsty. And I'm becoming more of that many people eat food when they're thirsty. And I'm becoming more aware of that. So I'll be hungry and I'll wait a minute, maybe I'm just thirsty. So keep your hydration, that's for sure. Okay, we're moving along. I think we'll have time for maybe to finish our panel discussion, which is rare. We're getting into our dividend pick of the week. So disclaimers, as always, Wall Street Hackers is for entertainment only. There are no guarantees on any of our suggestions, or nobody can give you any guarantees on anything, really. Obviously, I would say that CD is guaranteed, but if you're trading a treasury or CD, even that has principal risk. These are only our opinions. Consult your financial advisor. So one footnote, last week I very correctly, at least for the short term, said there was risk in AI, and I pointed out all these studies that pointed out that maybe AI isn't as great as they're saying, and it will develop slower than the market thinks. But I have no general position on AI. I don't have stock positions on it. I'm not sure. Maybe it'll grow faster. Who knows? I'm not an AI expert, but there is a lot of studies to say that there are issues with it, like hallucinations, and you'd have to watch last week's show. But I also said I like Amazon, and I still like Amazon the best of the Magnificent Seven, certainly. I don't like the chips because I'm concerned AI is oversold in terms of selling it to the public. And I'm concerned about some of the other companies because of antitrust concerns, which could affect Amazon, but I don't think so. I think Amazon's brilliant. So I suggested selling 200 puts, protecting 145 and 120. I still like it. And I said, only do 3%, as a suggestion of your risk portfolio. So, but I will point out, I like Amazon still. And if it goes down anymore, I'm going to start looking seriously. And I don't think it will, but who knows in the short run. Again, now these are very long-term options, so still could do very well with it. I think it'll be over 226 most likely. But if it goes down, maybe I'll look at selling 180 puts or 175 puts and protecting them at 145 and 130, because at some point it will stop going down unless the world heads to a total catastrophe. It's got a great multiple businesses, not to mention robotics possibly coming. So, dividend pick of the week. A couple of weeks ago, I mentioned Mondelez. It's done very well so far. I like it as an investment. We're going to do a group of food investments during the next few weeks. And joking around, I would say food is something that most people require, so it's kind of considered a necessity. This week, BNL, Broadstone Net Lease. Broadstone is a commercial REIT, and we only have a 0.5% allocation to that. And when I pick my allocations, obviously you can go more or less, depends how aggressive you want to be, whatever. I think I'm picking good companies. The evidence seems to be that way very strongly over the years in terms of their growth and even recent performance. But the REIT has 796 properties, including manufacturing, distribution, food processing, cold storage, and restaurants. What I like about it is it has a 6.7% yield. Price over cash flow is 7.6, so it has a 13% cash flow yield. So it's easily covering that 6.7. I always like high cash flow to pay out dividends, to protect dividends, to keep growth. And debt to assets is a very reasonable 0.36. So also, based on their own presentation, they said they're based on forward AFFO, which is an indication of REIT cash flow. They are pointing out that they're very undervalued against other REITs, including ADC, which I've looked at over and over. I'm kind of mixed on it, but it's okay. And a very popular one is O, Realty Income, and they show pretty good numbers against those two in their presentations. It's always good to go to the presentations. I learned on Wall Street, always go to the original source. I do that in politics. I do that in finance. Dick York, really bright guy, was my first long-term mentor till he went away to Illinois to discover card. But unfortunately, he would have been a great mentor for years, but I learned a lot from him in the 2 years I worked for him. And he always said, go to the original source or as close to it as you can. So in politics, I try to go to the original speech, or I want to see the original speech, not what somebody says about it. In finance, I want to go to the company and their actual numbers, their spreadsheets, whatever. But, you also look at other opinions, obviously, for different perspectives. So why only a modest 0.5% allocation? Well, mainly because the next few weeks I'll be talking about other allocations, including a really favorite of mine, a very large allocation that's very food oriented, and I'll save that for next week. So we better get into the panel discussion. We could be running tight again. We have about 7.5 minutes. The question of the week, and Nick can come on, is what is up with ridiculous NBC? Background. How ridiculous can MSNBC be? And are there any limits at all? During the RNC convention, day 2, I watched multiple channels because I was surfing. I'm always interested. How do they compare? I went to MSNBC at least 50 times. Every time I went, they had the Republican convention muted, whoever was speaking, not a word coming out, and they were just talking about them. Generally, obviously, we hate Trump, we hate Trump. But they kept, there's a label on there that says RNC convention coverage. And they're always saying, we're covering the RNC. Well, their coverage is to not let anybody at the RNC actually talk. So finally, Nikki Haley came on, and after all these times, she was the first one they actually let talk. They didn't mute her. And then she said, I endorse Trump. And within maybe, I don't know, a minute, they muted her and continued the conversation. Is this convention coverage, or is that just a misstatement right there? I'd say it's a misstatement. But let's say you think that's fair coverage. Even CNN actually let the people talk. So let's look at some other aspects of what it is. First of all, within hours, 3 hours, any one of these things, by the way, should blow them out of the water in terms of anybody watching at all. Within 3 hours of the Trump shooting, here's what one of the reporters said. I believe this is an exact quote. A source told us that Trump has a teardrop injury. A teardrop injury. Now, the amazing thing was, as he said it, the picture of Trump's ear was on the screen, the sole side of the head. You cannot say that it's a teardrop injury and anybody believe it. It's just reality didn't affect anything. But there's been also reporting over and over on other issues. Nick mentioned last week Project 2025. They're always saying, 2025 is Trump's plan. He's going to take over the country and he's going to become a dictator. This is his plan to become a king. Well, the day, I believe, before the assassination, Trump was interviewed by Harris Faulkner, And here's what he said, quote, "I don't even know what it is," close quote. And then I'm paraphrasing, but this pretty much everything he said. And by the way, you can see this on YouTube if you don't believe me. I've never seen it. I've heard it was a group, it was written by a group of conservatives, but what I've heard, I disagree with some of the ideas. So Trump hasn't even seen it, but it's his plan to take over the world. But let's ignore that, which should be enough to make one wonder why anybody would deal with MSNBC at all or believe them. Let's look at their history of what they've said. Oh, one more recent story. They said within days when Senator Menendez was just convicted on bribery, international bribery, because he had gold and cash in his 13 gold bars in his apartment and cash, huge amounts of cash. They're a pretty bad thing, right? Well, both CNN and MSNBC said that Trump's conviction, which was for a non-disclosure agreement check, which was not classified as an election contribution, that's what he did, was comparable to Mendez taking gold and bars. Misclassifying a check versus gold bars, I think there's a little difference there. Finally, we look at the history, years, months. MSNBC telling the public Trump is a Russian surrogate. He's a spy. Hunter's laptop is a Russian and Republican conspiracy. Any thought that COVID came from China are a Republican conspiracy, and it's racist. Asking about Joe Biden's health for years, it's a Republican conspiracy. And probably, I was going to say probably racist, but that wasn't racist. I'm joking. Anyway, so exactly how many times does MSNBC have to go off the total deep end before people start saying, why am I watching this ridiculous TV? Nick, we have 3 minutes. I'll give you
3 minutes. I can sum it up in like less than that. I don't watch MSNBC anymore. In other words, it's not on my channels. I mean, I get it, but Rachel Maddow just really turned me off. She's so arrogant. And at least she appears to me to be arrogant. I always think I'm arrogant. Then I see her and I say, I'm not arrogant because look at her. It's like, oh, I know everything. I know everything. And so she really was a big turnoff, basically. And then the rest of them I just don't see them to be very good commentators. They all have their agendas. So I don't watch it. I'll watch ABC, CBS.
But the question is, I guess we know that, but the other thing is people like to hear things that they agree with, but why would people fall for this ridiculous stuff after time they've been lied to?
You know, it's back to they want to be reinforced. I mean, it's the same reason.
Yeah, I agree.
Certain programs on Fox News or this. I don't watch this guy Hannity. There's a guy called Hannity. I don't watch. You know, so the extremists I just tend to stay away from because to me they don't really bring any value to what I'm looking for, which is facts. Now, when it comes to Project 2025, I've read a lot of it. It's 900 pages, and they all lie about it. It's just really weird. It's not, a lot of it's not that bad. It's by the Heritage Foundation, and if you go through it, and then some of the stuff they say.
It's by the Heritage Foundation. I didn't even know that.
It's the Heritage Foundation. That's their thing.
They're really generally intelligent.
Yeah, they are. It's really actually, if you would take the time to read it.
Right. No, they won't do that. I have to cut you off, Nick, but that was
they
really,
never did. Then
Nick,
they find out we only have a lot of good ideas.
I need my minute, but that was great, Nick. I didn't even know it was Heritage Foundation. The whole thing is Foundation. So here's my 3 points. One, I would think for MSNBC, it's largely about ratings, especially for management and programmers. They're willing to put anybody on to report anything if they, and any content almost, whether or not it's true, because it probably builds their ratings with people who like it. Number two, it's likely that some of these, or maybe all of these poorly selected reporters actually believe some of the absurd things they've been saying over the years, over and over again. So I would say if they have any ethics at all, they should start broadening their information sources. They need to look at things like they don't agree with, like Fox Daytime or Read the Post or something, and say, wait a minute, is this stuff I'm saying even true? And finally, like CNN, which is tanked, MSNBC's ratings are eventually going to fall. One, you can't fool all the people all the time. And two, they're not going to have Trump to kick around forever. In 4 years, even if he's elected, he's going to retire or phase out his influence. And it's not a great long-term strategic plan. So we are out of time, but thank you, Nick, for your comments. And we will see you next week. As Kim always says, get healthy and get wealthy. Have a good week. See you next week. Bye-bye.
Until next week. Bye-bye.